What you're looking at here is a lot of stuff, right? People today want stuff, they see stuff, they click a button and they buy it. There's so much stuff that's being accumulated. The challenge for most Americans today is they don't actually have the cash to pay for it, and they're throwing this onto credit cards. That's known as consumer debt. Today, we're going to talk about a strategy that you might be able to use to help get you off that treadmill of constantly accumulating debt. All right, so we're going to get into a strategy, and there's a lot of different things out there on the infinite banking concept. And one of the things that's talked about is how you can use this strategy to consolidate your debt. But let's talk about some of the things that are going on in today's society and the game plan around that. For millions of American households, after they siphon off money from their paychecks into stocks, bonds, and into retirement accounts that they really can't touch until they reach retirement age, they then discover that they can't afford their desired lifestyle. And so what do when they can't afford their desired lifestyle? Well, you need a car, they want to get a house, send their kids to college, pay for weddings. What do? They go into debt. They borrow the money, right? Because they need these things now. And the problem with needing all of these things now is that Americans in debt, the consumer debt is so large, and these numbers, they're going back to 2014, but just look at this, right? The national average household credit card debt was $7,000, and this is in 2014, right? Think about all the things that have transpired since 2014, going through the pandemic, and so many people losing their jobs. What does this debt look like now, right? But let's just focus on the households with credit card debt. That figure jumps from $7,000 to a whopping $15,000, right? And this is from Money Geek. The average APR on that credit card with a balance at the time was 13.14%. 13.14% on credit card debt. That's amazingly high, right? And that's just on average. There's so many credit cards out there. I've seen statements for people, 19, 20, 25% on credit card debt alone. And then you think about the interest rates that you're earning in a bank account. Right now in 2022, we're averaging like 0.04% in a bank account. So let's think about the absurdity of the condition, right? And that is that these households who have tens of thousands of dollars on credit card debt rolling over more than 10% APR while they simultaneously hold more than enough to pay these balances, but that money is tied up in pre-tax qualified mutual funds that feature a mix of equity and bonds. When questioned, the people making these financial decisions might justify the arrangement by saying that it would be irresponsible to tap into their retirement funds. Folks, what they need to be looking at, or what you should be considering for yourself, because if you're finding yourself in this situation, why are you saving into a retirement account that you can't touch for years when you're paying interest rates of 10, 15, 20%, right? That's money flying out the door on debt, on stuff, right? And when we started this video, we were talking about, consumer debt and stuff. But let's be honest, there are people today buying food on credit cards, buying all sorts of things that don't even last, right? So they can't even accumulate the stuff. They're just spending that money on the credit card with the intention maybe of paying it off at the end of the month. But a lot of times people are finding that they spend through all their money, and now they're carrying these balances, and these just keep adding up, and that's how they get in the situation of such high credit card debt. So think about the absurdity of this, right? People are holding on to dollars that they have, sitting in a retirement account, earning maybe 7, 10, 12%, but paying interest on consumer debt, which is piling up at a rate of 10, 15, 20%, right? So they're earning less on their retirement accounts while paying more in these credit cards. How do you get off of that? let me talk about a strategy that exists out there, and you may have seen it. We're not recommending this strategy, but let's just talk about it so you can understand and start to think about, would this make sense for you, right? So to get out of debt with money you already have, a common technique is to sell off enough of the outside assets, even if they're, paying taxes and penalties because these are in 401k or similar environments, in order to fund a dividend-paying whole life insurance policy large enough to allow for the rapid payoff of credit card debt. Now let's take a step back on this, right? What are they actually saying here? What they're saying is people will take their retirement dollars that they've set aside. They'll pull out from those retirement dollars, and if they're pre-59 and a half, they're going to pay a 10% penalty. That money that gets pulled out is going to be taxed at ordinary income in that year. So that's a thing that you need to think about when doing this. And I'm going to be honest with you, it's also a thing to think about, right? You might not be in credit card debt today, or you might not have a ton of credit card debt. Maybe you don't have a ton of savings yet, right? One of the things that you really want to think about is, before you make that decision to fund a retirement account, what does your liquidity look like today, and what does your debt situation look like? Because there's alternative methods of saving outside of retirement accounts to help put you in a better, stronger financial position. All right, so let's take a step back and think about that strategy that was just offered to you, right? The idea of selling out of your 401k and putting that money into a whole life policy. And by the way, it doesn't have to be a 401k. It could be IRAs. It could be cash in a bank account. It could be anywhere. But this is often the 401k is where people have the majority of their money. So let's talk about the ideas here, right? So on one hand, it represents just simply swapping off assets and liabilities. On the asset side, the household reduces its holdings of stocks and bonds in tax-qualified environment while raising its cash surrender value in the form of a whole life policy, and also the death benefit coverage, which has an economic value itself. On the liability side, the household pays off the credit card debt while incurring a comparable loan owed to the life insurance company. So let's talk about that in English, right? Essentially, you're selling off your pre-tax dollars, those tax-qualified dollars. You're paying penalty. You're paying the tax on it. You're then at some point moving that money into a life insurance policy, which has cash value. That cash value is then going to pay your credit card debts off, right? So let's say your credit card debt is $5,000. You take $5,000 from your life insurance policy. You pay that off. Why does this make sense? You have high interest credit card debt. You have lower interest loans from a life insurance company. And on top of it, if you're setting up these policies properly, you're getting continued compounding interest on the money that you just paid off the credit card debt with. What does that look like? Well, the idea is that's faster appreciation, right? Because you're earning interest on the money that you've paid out and settled your debt with. So you're creating that arbitrage. And the idea here is really a way for you to finance your own debt, right? And you're doing it through selling off these retirement assets. The one thing that may not be considered in all of this, or maybe we're not even thinking about, is you're putting your household in a stronger position short term and long term, because you're also protecting with a death benefit. So a word of caution with all of this, right? Again, I'm not recommending that anybody sell out their 401k and put money into whole life insurance policies. That's an individual decision made on an individual basis. And let's take a look at what really is going into that, right? The actual mechanics of the operation depend on specific numbers of the individual household. There are also IRS rules concerning how rapidly wealth can be moved into a whole life insurance policy. And furthermore, if there are large movements of wealth out of tax qualified plans, staggering that outflow might make sense to stay in a lower income tax bracket. Why would you stagger the money out, right? Think about this. If you had $10,000 in your 401k and you wanted to sell out of that and move it into your current world, you're going to pay taxes and you're going to pay penalties. those taxes are based on your current tax bracket. So by taking that $10,000, you've now added that to your income for the year. And that might be 10,000, might be 50, it might be 100. It looks like in that 1 year you earned an extra 10,000, 20, 50, whatever that number is that you're taking out. So with the advice of your accountant, you can look at your tax brackets and see, well, does it make sense to stagger out of this, or should I take this in one lump sum? So let's talk about what this means for you, right? So often people are looking for individual advice on this channel, and unfortunately, we cannot give that, right? We can talk to you about strategies that are out there in the world, things that are being presented to you, and really trying to help give you an understanding of what it looks like. But if you're ready to sit down with a team member and find out how this would impact you, click that link below. We'll go ahead and have a team member reach out and walk you through a custom game plan to figure out, does it make sense for me to even try to do this? Will my employer allow it? What are the different strategies that are involved? And how else could I handle this besides just using a life insurance policy? Again, click that link below and we'll get you started. Hey, thank you so much for watching and getting this far in the video. If you're liking this content, go ahead and hit that subscribe button. There's more like this coming out every single day. And if you found this beneficial, wait till you check out this video.